United States dollar still is the dominant currency in the world. COVID took off, massive money printing. This is not a crisis predictor. It's just to show you perhaps the tools in the toolbox that they have left. Hey everybody, welcome. My name is Matthew. Thank you again for joining. We are continuing on with our series on the United States national debt. Not finished yet. If you want to look back in the prior playlist of this series, we have a lot of great episodes covering taxes, interest, money print on a trailing 12-month basis. This is the same chart that I showed in the last video, but instead of just showing the percent of the Federal Reserve's portion of the United States debt, I'm showing it as a cents on the dollar. It's the same thing, but we're going to draw some percentile bands to show you where we are in the trend today. All right, so think of this as for every dollar that the United States Treasury has issued in debt, this chart is going to show you how much of it has been printed. And that number can go up, it can go down, they can print more, they can decrease the rate of printing or print a little bit less relative to before. Let's say for every dollar of United States government debt outstanding at any given time, this is how much has been printed. This is brass tacks on the money print. All right, so I'm not going to do the whole history again. We've talked about this many times. For the history, see prior videos. We see in the early years, the Federal Reserve did not own much at all of United States debt. 1 to 2 cents of every dollar was printed by the Federal Reserve. That went up to 10 cents during the Great Depression, and during the peak of the Vietnam War, the crescendo, I should say, which is actually the end of the Vietnam War, got up to 18 cents. All right, so for every dollar that the United States had issued, the United States Treasury had issued in debt at the end of the Vietnam War, the Federal Reserve had printed 18 cents of that dollar. For every dollar, so 18% of the United States debt was printed by the end of the Vietnam War. And it only took going from, by the way, 18 cents to about 15 cents or 14 cents in 1980, 1981 for Paul Volcker to raise interest rates up to 20%. Okay, so he's removing the floor, he's removing the interest of the Federal Reserve, the buying power of the Federal Reserve's money print on the Treasury. And so what happens there, the price of bonds will fall, the yield will rise. It only took the Federal Reserve taking their foot off the gas to the tune of 5 to 6 cents for interest rates to rise to 20%. That's a side note of this video. And it went down further till the eve of the global financial crisis, back down to about 10 cents on the dollar. Corporate bailouts here, they removed a lot of treasuries from their balance sheet, took on a lot of corporate debt just for a small period here, went down to only 5 cents on the dollar. It was money print during the thick of the global financial crisis. Then they swapped out all the bad debt of companies, gave them good United States debt, and they took on the mortgage-backed securities, the bad debt, all that stuff, QE1, 2, and 3, to the end of QE3 by 2015. For every dollar of United States debt that was issued and outstanding, the Federal Reserve had printed 23 cents. Went down again. All right, they tried to normalize the balance sheet all the way here to 2019. And you see we get here to September 2019. For every dollar the United States had issued and outstanding, 16 cents on the dollar. Then they had a little repo crisis here. The market wasn't comfortable with that. I'm going to zoom in. Actually went up here from September 2019 to March 2020. You can see it's trending up, but it still rounds to 16 cents. But there was a crisis there. All was not well even before COVID took off. COVID took off. Massive money printing. It rises up to 23 cents on the dollar, and it peaks here. Let's zoom in again. It's somewhere around November 2021 at 28 cents on the dollar. So during this period, October, November 2021, for every dollar of United States federal debt issued and outstanding by the Treasury, the Federal Reserve printed 28 cents. And then as I've shown you in prior videos, if you look at a trailing 12-month basis, that goes down. They have decreased the money printing since then. And I now have this updated through May. They only hold about 20 cents. Okay, it's still a lot, but compared to what it was in 2021, it's 8 cents less. Let's put a trend line to all this. Let's try to understand what this all means in the course of 100 years of Federal Reserve history. The best fitting trend line is exponential. Here it is. It's 54%. It's not a great R squared. It just means that the data, the green area, moves around this black line 54% better than it moves around the average, the all-time average of the green data. Just understand that it's an okay fitting trend line, you can see, but obviously we can go decades, we can go generations with it not even touching the trend line. But we're back up very close to the trend line actually as of now, And then let's put the, as you know, I like to do the percentile bands on the 1 sigma down, 1 sigma up. What does this mean? This means anytime you see a money print that's in between these blue lines, it's going to represent a 1 sigma event, or it's happening 2/3 of the time. 67% of the time, you'll be in this range. And where are we? We're within range. So we're in 1 sigma right now. We're within 1 sigma. We're in a completely normal distribution. Let's put 2 sigma down, 2 sigma up. Very rare error. You'd actually have to go back to the Great Depression to find it on the upside, the global financial crisis to find it on the downside. 2 sigma means anytime the data is within the red bands, that's a 95 percentile event. It means 95% of the time the data is going to be there. If it's outside, then it's a very rare event. 2.5% on the upside, 2.5% on the downside. That's how I'm calculating it. It's a 5 percentile event. 2 sigma event if it goes outside. So that's where we are. Now, this is an exponential regression. So what does it mean? If we put this on log scale, log left-hand axis, this is going to turn into a straight line. So this can give us another perspective here as we finish off this video. Federal Reserve was not involved with the United States Treasury. It was practice during the Roaring 20s. You can see here is just a couple cents on the dollar they owned of United States government debt. Great Depression, it bumped up. Look at the green print, 10 cents. What was 2 sigma up? 8 cents. It was very rare, error to the upside. And then I'm just going to move here to Vietnam. At the end of Vietnam, 2 sigma up was 20 cents. The debt print got up to, as you see there, 18 cents. So very close to the 2 sigma up line, which depending on where you are, 19, 20 cents. 2 sigma down, very, very rare error what happened in the global financial crisis. And this was really just a swapping of bailout money. Eventually, the banks got made whole with fresh United States government bonds that didn't need to be heavily discounted because they weren't backed by junk mortgage-backed securities. The Federal Reserve took all that on, as well as the federal government with some guarantees, but the Federal Reserve took all that on here in QE 1, 2, and 3. And that's where we are today. All right, so you see the black line, that's the trend line. Let's just zoom in. We're just a little bit under trend. So even though this is a different perspective now, even though we have over $34 trillion in debt, it's a huge number that doesn't even factor in the unfunded liabilities of Social Security, Medicare, and Medicaid, which is at least 50 trillion more. The United States government is going to face huge fiscal headwinds, all that stuff in the future. All those things are going to be difficult. We're on trend. That's what you need to see with this video. We're on trend. And if anything, the Federal Reserve is printing less. This is why interest rates are so high now, because they've removed the floor to government bonds. They're not buying as many United States government bonds, notes, and bills. That's why interest rates rise, because the bond price falls because the Federal Reserve isn't buying as much. That's how it works. So you can see that translate into this chart. They only own, quote, only 20 cents on the dollar right now. And if we project this trend line out, let's just go out to the end of, actually not at the end of the decade. Here I only have till 2027. Which is fine. But let's, the next cycle, let's say another 3-4 years here. The trend line itself only goes out to 25 cents. 1 sigma up would be 44 cents, and 2 sigma up, which would, in my opinion, would be very, very dangerous, bad territory, 57 cents. Federal Reserve's nowhere near that at the moment. They're only at 20 cents on the dollar money print versus United States Treasury federal debt outstanding. All right, for every dollar, Federal Reserve only has printed 20 cents. Again, I'm not defending the Federal Reserve's policy. I'm not saying it's a good thing. I'm just saying if you look at the long scan of history here, and the United States dollar still is the dominant currency in the world. I'm not talking about Bitcoin, not talking about gold. We're talking about the dollar. The Federal Reserve has removed themselves from some of the craziness that happened during, let's say, QE3 and COVID. But again, it's not necessarily guaranteed that that's going to put them in a great spot. Because, look at what was happening here before the global financial crisis. They were hovering around a pretty low level. All right, I'm looking at the 1 sigma down, all right, which is about 10 cents on the dollar of money print to debt on the eve of the global financial crisis. They were at 1 sigma down for the trend line, and the global financial crisis still occurred. Okay, so this is not a crisis predictor. It's just to show you, as one of the commenters wrote, perhaps the tools in the toolbox that they have left. Again, I'm not a fan of these tools, but this is what they like to say. If we have another crisis, if we have another problem, the Federal Reserve can print up to, let's just say, 50 cents on the dollar, and they still would not be at a 2 sigma up move, which the last time they hit that was roughly at the end of the Vietnam War. Hopefully this gives you a different perspective on what it means to understand the relationship between the money print, the Federal Reserve, and the debt, the United States Treasury. We're still not done with the United States federal debt 100-year, in this case, and 200-year history. If we pull it all the way back to the founding, we'll continue that in the next video. Let me know in the comments what you think. Thanks for watching.